Welcome to Deloitte M&A Views, a Deloitte podcast series exploring the latest trends and topics in mergers and acquisitions. I'm Greg Jarrett, and today we're discussing M&A activity in the consumer product sector, specifically exploring four common types of M&A transactions and the importance driving business model coherence as part of integrating two businesses. We're joined today by two of Deloitte's consumer products M&A leaders, Brian Barnes, a partner with Deloitte & Touche LLP, and Shashi Yadavalli, a principal with Deloitte Consulting LLP. Brian, I'd like to start with you. Maybe you can kick this off with an overview of deal activity in the consumer product sector. It seems like it's been extremely busy of late.
Overall deal volume in the consumer product sector remains very strong year to date and this fiscal year. We're particularly seeing a lot of activity, both domestic and inbound, in the food and beverage space. A lot of this has been influenced by a relatively iconic deal that happened in the retail sector, which is affecting the sales channel and e-commerce. But a number of other factors, such as the continued increase in health and wellness concern, which is having an impact on demand for organic ingredients and food on the go or portable food, the influence of the millennial generation, and there's just an elevated overall consumer confidence coupled with increased consumer spending that's really having an impact on M&A deals.
The landscape seems to be changing drastically as far as consumer products are concerned. Shashi, let me ask you this. In the opening, I did mention that we'd be exploring four common types of M&A integration. What are these four types and how are they defined?
Sure. Thanks for the question, Greg. We've categorized the type of M&A integration activity into four types, primarily along two different dimensions. One is the relative size of the two companies, of the acquirer and the target, and the other dimension being how similar the business models of the two companies, again, the acquiring company and the target company, are. And based on those, we've come up with four different types, and we've labeled them merge, which is really having two organizations of comparable size and very similar business model. A tuck-in, which is an integration of a smaller company, but very similar business model. A bolt-on, which is acquisition of a smaller company with a very different business model. And transformation, which is acquisition or the integration of a target of comparable size, but very different business model.
Well, that leads me to my next question for you, Shashi. Is there a major factor or factors that can lead to a successful or perhaps not so successful merger or acquisition?
Well, there are several factors across the deal life cycle that can impact the success of the transaction overall. Whether the target was a good strategic fit in the first place, was there effective due diligence performed? Did the acquirer pay a fair price for the target? Was the integration sort of well handled? So there's several aspects, but one that I would like to maybe highlight and focus in this conversation is the ability of the acquirer to realign the business model of the combined company so that the post-integration, the combined organization operates in a very coherent fashion. We just published an article called the M&A Matchmaking, where we've done some research looking back at M&A integration activities for over 100 consumer product companies. And our research shows that companies that drive toward a coherent business model in the long run generates nearly 50% higher shareholder value compared to the rest of the population. And M&A transactions, especially several bolt-on deals or a major deal of a company that with a very, very different business model, the transformation type of deal that I just described earlier, can significantly disrupt the business model coherence and may require a very deliberate and concerted action to restore the balance of the business model. In the article, we discuss a series of checklists and actions that can help drive better coherence as the companies are embarking on their integration journey.
So, Brian, what impact can business model alignment have on the outcome of a transaction?
The alignment really helps the companies make focused investments into areas where they choose to play and win. Operating with a hybrid or kind of mixed model can create strategic and operational conflicts and lead to suboptimal performance. Just due to their nature, M&A transactions tend to have the most sudden and disruptive impacts on maintaining a coherent business model. However, a complementary merger or tuck-in where a company acquires a smaller target with a similar business model results in a combined company whose overall business model is relatively unaffected by the transaction. On the other hand, when a company acquires a company with a different business model, regardless of the size, the outcome can be a sudden or dramatic reduction of coherence. And we have seen time and time again the detrimental impact on business performance and value creation.
In the last 12 months, we've seen at least one major acquisition that I don't think anybody saw. It came right out of left field, and it could be called disruptive in the extreme. Is this going to become the norm in the future, disruption over all else?
I think in the short term, you're going to see some additional disruptive deals that we probably wouldn't have seen coming. And the deal that happened earlier this year was somewhat of a launching point for that and really got people thinking differently about strategic options through M&A. So will it become the norm? It would be hard to say, but I definitely think that we're going to continue to see some mergers or acquisitions between businesses that we probably hadn't thought of in the past.
Shashi, does this type of merger, this type of integration take a lot more extreme thought and a lot more procedure than perhaps what we might consider to be a normal acquisition or merger?
It certainly does. Building on something that Brian mentioned, I, for one, would expect that these types of disruptive transactions will become more mainstream. We're already starting to see consumer product companies early on. Most of the transactions, the types of deals that they would do were buy other brands or use M&A to expand into a new market, new geography. Increasingly, what we're finding is the nature of the deals are changing. Increasingly, consumer product companies are buying technology companies. They're buying online capabilities. They're buying digital marketing agency types of capabilities. Very, very different business models. It requires a fair amount of thought. It requires a lot of deliberate focus on how they put the two organizations together to truly extract the value of making these types of non-traditional or disruptive types of transactions.
Shashi, two boards of two separate companies look at each other and say, this is a marriage made in heaven. Our business models match. But besides business models, should anything else be considered upfront before engaging in this deal?
Sure. A decision on whether to embark on a deal or not cannot be guided by a single factor, like a business model coherence. We would recommend that clients look at several factors: scale, the potential to create value and synergy through the combination, the impact that the combined organization has in the competitive landscape, price. These are all conditions on whether an organization should move forward with the transaction or not. In fact, we've seen that more savvy deal makers actually don't mind experimenting with targets that have a different business model. What we have found, though, is when highly coherent companies, they make the bold move to acquire a target with a very different business model, they have a very deliberate integration strategy. They follow up with a series of transformative changes that help align the business model of the combined company to avoid or to improve the coherence. They identify the potential issues that could drive that tension from a business model incoherence perspective early on in the acquisition process, even as far early as when they're trying to select different targets. And they have very deliberate strategies that they deploy during the integration process to mitigate that.
At this point, I'd like to ask each of you to help me wrap this up, to summarize. I'm going to start with you, Brian. Do you have any final thoughts?
Sure. I would just reiterate that companies that deliver exceptional value for their shareholders tend to approach M&A differently. They focus not only on delivering the acquisition's expected synergies, but also make a deliberate effort to maintain business model coherence.
And Shashi?
Echoing Brian's perspective, I think as long as companies have a laser focus on value not just getting the deal done, but really how they're going to extract the value from the combination. And they're thinking about beyond synergies and beyond getting to a flawless day one, etc., being very specifically focused on how to fix the business model coherence issues that the combination may cause. I think they dramatically improve their odds of being successful and extracting value from the combination.
I'm Greg Jarrett. Thanks for listening to Deloitte M&A Views, sponsored by Deloitte's M&A Institute. This podcast is provided by Deloitte and is intended to provide general information only. This podcast is not intended to constitute advice or services of any kind. For additional information about Deloitte, go to deloitte.com/about. We also release new podcasts regularly. And if you subscribe, you won't miss a single one. To stay connected and receive more information on Deloitte's M&A service offerings, visit deloitte.com/us/MA subscribe and follow us on Twitter at Deloitte M&A. Until next time.